Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we want to talk about an asset class that we use in our portfolios, specifically commodities and natural resources, but we want to drill down a little bit further and even talk about gold, the other precious metals and base metals, because those questions have been popping up. Gold actually 2 weeks ago, around the May 15 timeframe, I got a phone call from a journalist asking me, what about gold? Is now the right time to buy gold? Of course, at that particular time, gold was up by 15%. I think as of today, it's June 5th, 2024. Gold is trading around, I think it's up around 13%. So it came back a little, but it was definitely at the height. And she was asking, should we buy gold? And I started actually seeing things popping up on my news feeds and so forth. Oh, it's a time to buy gold. So Steve and I thought we might talk a little bit about gold. Gold certainly is an interesting asset class, and it has done considerably well, particularly over the past year or so, since actually October. Steve, I don't know if you want to switch to the next slide. It shows exactly when it started performing. Why is gold performing? Well, as of October 7th, 2023, we had, of course, a very severe situation happen across the world. We have a lot of geopolitical risk, and anytime people feel that there's a lot of uncertainty in the overall geopolitical landscape, they tend to run towards gold. Gold is tended to be perceived as a safe haven.
It is, and it's also something people, I think, especially preppers, like, because they think that when everything crashes and we're living in caves again, it's a method to store value and actually something you can use to buy goods and services in the future. The problem with that being, of course, it's actually an article in the Wall Street Journal about owning gold outright. If people aren't aware of it, Costco sells gold bars now. Liquidating those gold bars, you can take a pretty decent haircut, even if there's a serial number on it. In other words, there's a certificate that it's proof that it's 99% pure. You could still take a 5 to 8% haircut on liquidating.
Well, the transaction costs are high.
That's it.
Even the coins as well. We've seen people don't get the full value for that. So
no, unfortunately.
But what a lot of people will do is they'll buy an ETF, such as GLD, which is a spider ETF. And that's actually on the next page. Oh, no, not yet. We don't get there yet because, but on the next page. So the biggest reason why gold is going up is the geopolitical risk, people looking for a safe haven. And the second is that the central banks are buying a significant amount of gold. And they have been over the past couple of years since inflation has started to rear its ugly head, because right now they need to do that in order to safeguard against their currency losing exposure. And this is happening across all the countries. China's probably the #1 buyer of gold, but a lot of the European...
Which is a little scary, by the way.
It is scary. But Germany and France and Italy, the United States are all buying gold, and they've bought significant tons, as you can see here. I think it's over 1,000 tons over the past 2 years, more than they've bought in the past. So it's certainly driving the demand.
I think a lot of people would hope that we'd go back to a gold standard too, because it limited the amount of currency that will be in circulation. And the amount of currency in circulation is certainly a huge contributor to inflation.
We were looking at what some of the forecasters were actually predicting in terms of gold, and we've seen a lot of really lofty predictions. This prediction actually came from JP Morgan. They published in January 17th, an article specifically saying, will gold prices hit another high in 2024? And so what we do know is the first quarter came about, and the actuals actually exceeded their forecasted amount, which is interesting. The end of June will be the end of the second quarter. We don't have that information yet, of course, but today, as of June 5th, the actual price is $23.26. Now, if you look at 5 o'clock on this page here, you see that they're predicting at the end of, oh no, I'm sorry, that's 2020. I guess I should say, what is that?
End of the year, you trying to look at?
The 4Q 2024,
Yeah,
they're
2175.
expecting, JP Morgan was expecting 21.75 per ounce. I've heard some predictions as high as 20.60 an ounce.
So much for predictions once again, right?
Well, could be, who knows?
Yep.
We tend to take all of these predictions with a grain of salt.
Yeah.
Steve and I spend a lot of time researching, a lot of time listening to the economists, a lot of time, and we know people personally that big names, and everybody has their own ideas of what it's going to happen. We tend to, this is not a presentation to tell you to run out and buy gold. It's
No.
a presentation to help give you a perspective, and we hope that we are able to do that.
Yeah, and don't, we're not trying to make any predictions here at all.
Right.
We try to look at solid data, but we try to not make predictions or project into the future what's happened in the past.
Right. Right. And so our first question to a journalist or to somebody that comes and says, should I buy gold? We take a step back and say, well, what's wrong with the other metals? Would you consider adding some other metals like copper and silver and
Yep.
aluminum and those types of things? And why would you want to do that? Well, the next slide shows that they also have done quite well year to
They
date.
have.
So if we have a year to date number of gold as having delivered, it's the purple number, 12.6% return. Silver has actually done even better.
Yeah.
And silver at least has some other opportunities, right? It's an industrial metal. So
Yeah.
you can use it both as a precious metal, but even as an industrial metal.
Yeah, gold has limited uses from an industrial standpoint. It is used in contacts and electronics, but a very tiny amount, usually just a coating on the contacts. Yeah.
Silver, and then copper also, if you notice, copper has a tremendous, which one? It's the blue, I'm sorry. So
Yeah.
up 15.9%. And copper has a lot of especially I believe in the electrical arena, has a lot of
Yeah.
uses. And I've actually seen some projections that copper is going to double over the next 10 years, which
Yes.
I'm sure there's somebody that's listening to this that's going to say, let's put all of our money on copper. Please don't do that.
Yeah, don't.
Because these are forecasts by
Yeah.
people that think that they're pretty smart, but they don't have crystal balls.
Well, there's a huge demand for copper now for EVs, and yeah, an EV uses about 10 times as much copper as does an internal combustion engine based car. So that's a big difference. I think the average is about 300 pounds per EV versus maybe 30 pounds for an internal combustion engine car. So there is, additional demand for that. And, a lot of other reasons too. We look at data centers, all have electrical wiring, the grid, they're going to have to increase the capacity on the grid. That a lot of that's copper, not all of it, but a lot of it's copper. So the demand is really there for copper. That's for sure.
And aluminum even has done well as well. So
Yes.
they've
A lot of
all
demand for
done pretty
aluminum.
well.
Yes. Yep.
Yeah, these are all iShare types of passive investments in those different metals.
Years ago, I think aluminum was much more costly than copper because than gold, because the amount of energy required to extract aluminum from its ore, which is called bauxite, is enormous, and it was very difficult to extract until I think it was late 1800s, possibly. It used to cost more than gold, believe it or not.
Right. So there's a lot of things that are driving the demand of these different metals and
Yes.
the price of these metals, as well as the return. However, we don't just look at that when we're investing for you. As you know, we are strategic asset allocators. We believe very strongly in building strong portfolios that are looking to have you invested over the long run, keep you invested, generate reasonable returns while reducing risk. And so what we're always looking at is before we decide on putting an asset class into our portfolio, we want to know, how is it going to enhance our portfolio? How is it going to make our portfolio better return, less risk? Always a measurement, always something that we're trying to achieve. So we look
Right.
at how the asset class is related to, for example, the US market. We look at how that asset class is related to all of our asset classes, but one specific one is, how can we diversify away from the US market? And
That's right.
so here you can see, this is a correlation matrix. It's a little hard for people to read, oftentimes, if they're not used to looking at it. On
Right.
the top, you can see on the left-hand tippity top, you see gold, and on the row, on the column, you see gold. And so when you look at gold and gold are 100% correlated. It's the same asset class. But
So the
when you
diagonal.
go across, you can see gold
Yep.
versus silver. They're still pretty highly correlated at
They are.
0.8. But they're less correlated. And then if you go all the way to the right-hand side of the chart, you see that gold's related to the U.S. stock market, as measured by the S&P 500, is very hardly correlated at all. And so that does point to it being a reasonable asset class to be in a
Right.
portfolio.
What's interesting here is, if you notice that gold, the correlation of gold with other metals drops as the metal is a metal that's more widely used in industry, which is interesting.
It is interesting. And then we also have Brent crude, which we also invested, and
Yes.
that's much less correlated as well. So
Yep.
yeah, so in terms of, does it have a place in our portfolios? It absolutely does.
It does. Yes.
Now this correlation matrix was actually compiled over a period of time, and I don't have the period of time. I had this slide, and I'm not sure even where I got it. And correlations do change.
They
If we
do.
look at the next slide, however, it now flips to saying, you know what? Let's not just look at gold and metals, precious metals, base metals. Let's look at commodities as a whole. Now, commodities include a lot more than just metals. They include oil, as we were mentioning, natural gas. It includes agricultural products, as
That's
well
right.
as so in the commodities thing, there's an overlap, because when somebody says hard assets, that is kind of the commodities with real estate. When
Yep.
we talk about commodities, it's usually not including real estate. So,
Now, I think of commodities as key, I would say, precursors or inputs into some industrial process. That's what I would think of commodities as.
but tangible,
Yeah, tangible,
tangible
yes.
product, right?
Other than real estate. Yep.
Right. And so when you look at commodities versus US equities, I mean, we looked at gold versus US equities, it was low. Commodities as a whole, and this is over a 50-year period. So it's a good time frame, a long time frame,
Yes.
still lowly correlated. And then there's another slide that shows over a 10-year period, a very,
Yep.
very similar number, 0.4. And so
Yep.
commodities are less correlated with the US market than real estate and some other strategies that people use to diversify away from the US stock market.
Yes. And we always caution people, we'll show in a slide or two, like that correlations do change through time. So
Right.
so this is interesting. The question is, are we entering a different time period in which gold and or commodities will behave differently? And we saw how this is gold, I think, right?
No, this is actually inflation. So,
Oh, this
so
inflation.
the red line
Oh,
here,
yeah,
the red
just average
line
inflation, right?
across the shows
Yeah.
inflation at 3%, which has been the average inflation for 100 years. And it
1926.
shows when it's below the line and when it's above the line. And so I circled here the point where it's above the line,
Right.
significantly above the line, which really occurred between 1968 and 1994, when inflation was above 3%. And so the question is, are we entering into a new regime? And is that there another period of time where we experienced this regime in the past? And can we learn something about it?
And the question always is when you look at a graph like this, you see the spike in inflation, but we also saw something similar in 1954, but then it dropped back down. So the question is, will it continue to go up? Will it stay above the line? Or will it stay below? We just don't know. There's so many factors. A lot of it has to do with the demand for different products, also cost of energy, because energy is a huge driver of inflation, by the way, because energy is an input into every aspect of the economy, production, different products, transportation, travel, pretty much everything. And also the money supply is another factor that affects inflation. So where is it headed? No
So
one knows.
when we think about what happened in the 60s, Steve, there was an unprecedented excessive fiscal spending in the
There
60s.
was, yes.
And that's a lot of what caused that. And then there were a series of things that
There were
of
supply
course
shocks in oil.
exacerbated.
Yep.
Yeah.
Yep.
But yeah, even from the very beginning, when people were talking about inflation being transitory, I know, Steve, you and I talked a lot about the fact that we didn't believe it was transitory, because
No.
when you spend the way our government spent and put the amount of money out there and increase the money supply overall, the M2,
Right.
there's no possible way that it could have ended any differently.
Nope.
And there are other things going on also that many people think may maintain inflation a lot higher for longer periods of time, and that's the increase in cost of production. If you just
Right.
look at labor, the increased costs of producing and serving clients in the service industries by the cost of labor, but also the cost of producing products. Because if you remember, what really caused the lower inflation over the past, I don't know, how many years, was us moving all of our production offshore to places like China, where
Right.
the cost of production was much cheaper. What are we
Yes.
doing right now? We're moving it all back, and we're moving it to our country or to other countries, maybe South America, where the
Yeah.
cost of production is higher. So I don't know how we get out of this inflationary environment. I think it's a lot harder than what they are projecting.
Well, what's happening is there's the government is actually working contrary to the Fed by also adding all these regulations. The amount of regulations passed under this administration have been enormous, and someone estimated 1.6 trillion in additional cost to the economy. So that adds friction. Just like we saw in California, they raised the minimum wage for fast food restaurants that have more than 50 locations, over $20 an hour. That drives inflation. It does other things too, but it also drives inflation. So there are a lot of things. Yeah. Yeah, there are a lot of things that are driving inflation. Now, I will say one positive aspect is that right now the United States is the greatest oil producer in the world. It would probably even be even higher if it wasn't for some government regulations. But I think we're over 13 million barrels a day right now. It's enormous. So that's, I think, has helped make it better than it could have been. We haven't had the supply shocks we had in the 70s with energy. It's all the new drilling methods they have and the methods of extracting oil from hard to reach places through fracking and other reasons.
Mhm. Now, commodities definitely are an asset class that it's not so correlated with the market, and so that's
Nope.
good. And so when we actually were able to get this page, which shows that period of time where inflation was above 3%, so from around 72 to 1993, what was going on. The green line shows the correlation between stocks and bonds. And you can see that during that period of time, stocks and bonds were positively correlated that entire time. And we've
Yeah.
shown you in the past slides, actually, we showed you a study that was done back into, I think it was the 1700s, where it showed stocks and bonds correlation over long periods of time, where sometimes it's positive and sometimes it's negative. During this period of time, they were positive. But then it also shows the blue line, where in the beginning part of that inflationary period, they were negatively correlated. They both had really strong returns, though, during that decade. And so because of their strong returns that were both occurring at the same time, they then wound up becoming much more positively correlated
Yeah.
and then negatively correlated again. So we can't always depend on them to remain negatively correlated.
And this is also a reason why correlation is not really the best statistical measure of the interrelationship of performance or price of two asset classes. And, well, we're not going to get into the technicalities here. We use a much more complex statistical measure to measure this interrelationship of different
Someday,
assets.
Steve, we should. I mean, we use a lot of statistics and they're very interesting.
They
They
are.
tend to be more non-parametric statistical metrics because
Yep.
returns are not evenly distributed. They have
Nope.
skewness and kurtosis. And
Yep.
it's a very, very interesting analysis that we do. Someday we should actually present something like that, Steve, for those that want to watch it. Not everybody will enjoy it,
We
but
should. And actually, we did do a somewhat a version of it up on the website is a talk we gave at the NAFA conference about three to 4 years ago.
Steve, that's an hour long. It's
I
very
know it
long.
is.
Nobody's gonna. It's very, very technical.
No,
I
we
don't
did
know how
cover
many
some of it
people can
there.
sit. We
We
did
can do
that
a
for
watered,
financial advisors, and they couldn't handle it.
yeah, we can do a watered down version of it. We liked
Okay.
it though.
Yeah, we did. We find it interesting.
Yeah.
So I guess we just wanted to mention and talk to you about how we actually invest in precious metals,
Yeah.
base metals, and in overall commodities. And the truth is that we look to invest in all of these things. We do have precious metals like gold and silver and base metals like aluminum and copper, but we also have a significant amount of exposure to oil and natural gas, energy, and agricultural products. And yeah, this shows the more detail of exactly. You can
We even
see
invested
that.
in the New York Harbor.
Yeah, that's right.
That's actually heating oil.
Right. But people, if people want to know, am I invested in gold? Yes. Am I
Yes,
invested in
you are.
silver? Yes. Am I in copper? Yes. Am I in aluminum? Yes. A little bit. We do think that these asset classes, all of them are volatile. They're not really reliable. I don't think
Nope.
that we really want to take on too much exposure in these items, but enough that we can have a performance like in 2022 when
That's right.
people's portfolios were down so much because they were invested in the 60/40 stock and bonds. And
Yep.
so they were down 20% and beyond. Our
Yep.
portfolios weren't down that even half that much. And
That's about right.
commodities, natural resources were a big player in that. They were up by 16%, Steve, or was it
I think
more?
more.
It was more, right?
It was like 40 or 50%, I think.
Okay.
It was crazy. Yeah.
Right.
That's when inflation spiked, and there were the particular holding we have is very sensitive to inflation because it is this broad combination of commodities that are within it.
So rather than focusing on trying to find the next gold star that's going to win over the future and looking at forecasters and trying to guess at, we're looking at trying to find the asset class that's appropriate for your portfolio to
Right.
reduce risk and keep you invested.
Well, you prove one thing, don't listen to JP Morgan, right?
Well, I wasn't trying to do that. They're no better or worse than any of
No,
the PhD economists that we know and love well.
that's
They
correct.
all are trying to do their best at forecasting something that's really pretty much unforecastable. Is that a word?
Well, I always love to say, mathematics started to begin to be used in economics in the 1920s, and there's a great book on that right now, the biography of Milton Friedman. But the problem is some of the simple equations work pretty well, some of the basic relationships, but some of the more complex ones, there's factors they can't identify, and the things that change, the interrelationships change. It's really hard to
Too many
apply
variables.
mathematics.
Way
Yeah,
too many variables.
that's
Yeah.
correct. Yep.
So we do believe that we are in a different market regime, if you will.
Definitely.
We do believe that there is a place for commodities and hard assets in people's portfolios going forward, more so than they have been over the past 10 years. we also believe very, very strongly that value is going to play a significant role in portfolios going forward.
Yep.
And so we've talked a lot about value in the past. I think hopefully you can expect to hear more about value in the future.
Yep.
We were talking about our next video, and we think we might actually make it about value. So
Yes, definitely.
please, thank you for listening to us. Please come join us again, and hopefully you'll hear about value. Thank you.